Okay, welcome back. This is part 5 and actually the end of our talk about chapter 6. And we just left off with the general rules about these miscellaneous 2% of AGI deductions. And there is a real quick example in the slides. So, what we have here on the slide is three different sources of these miscellaneous 2% items. We had unreimbursed employee expense of $1,500, tax prep of $8, investment expenses of $1,000, and then we're told our AGI is $120,000. So if we want to know how much we get to deduct, we just apply that same formula that I was just talking about. So real quick, we go over to Excel, the miscellaneous stuff, the formula in general, add all your miscellaneous 2% items together, and then just subtract 2% of AGI. If you're left with something, there's your deduction. So I already typed this out next to our old examples from casualties. So we had that employee expense of 15, tax prep of 8, investments of 1,000. That's total of these miscellaneous expenses of 3,300 bucks. Our AGI was 120,000. 2% of that is 2,400 bucks. So the difference between this lump sum and our 2% limit is 900 bucks. There's our deduction. If we got rid of some of these, like say, we didn't have this employee expense, so we only had 1,800 bucks related to tax prep and investments. That 1,800 that we're left with would be less than 2%, so our deduction would go down to zero. And that's really about the extent of this 2% stuff. Now, there are still some other seemingly miscellaneous deductions out there that just don't fall in this 2% category. For whatever reason, the government has decided not to impose this 2% limit, but they're not covered in any of the other sections that we've discussed, relating to taxes or interest, charity. So they're still kind of miscellaneous, but we don't have to lump them in to this kind of calculation. We just get to deduct whatever amount we have. The one that we're going to talk about in this class is gambling. So real quick, going to the slides. And there's a real short explanation here about it because, like I said, we're just talking about gambling. The idea when we have gambling winnings, so we go to the casino and we come out with more money than we had going in, that's income from all sources derived. It goes all the way back to those first few chapters we did. So since we're supposed to include all of the income we get when we win at gambling, there's a provision out there that says if you, in the same year that you win at the casino, if you go back the next day or something like that and you have a bad day, you lose. The IRS allows you to take some of those losses to offset that other gambling winning income that you're supposed to report. So they don't completely subsidize your gambling activities if you only lose. That becomes just personal. But to the extent that you win one day and lose the next day, the IRS will let you take some of those losses to offset winnings, and maybe you net to zero. But at the very least, you're not taxed when you win and then you have no benefit whatsoever when you lose. There's a little bit of a silver lining there in that you just get to net what you won with what you lost. So what I've put in this summary here, the limitation on gambling losses is simply the amount of winnings that you had in that same year. So if you only lose, meaning you never have any gambling winnings, your deduction is zero. You can't deduct unless you've already got some other winnings that you're reporting on your tax return and you are trying to offset them with other losses. So if there's no winnings, there's no deduction. If there's more losses than there are winnings, then that amount that's left over, that it just goes away. You're left with just more losses than you had, but at least in terms of taxable income, you're down to zero from gambling. So you add up all your losses from gambling for the year, and you just deduct a piece that will offset some winnings that you have. If you had a really good year and winnings were more than the total losses you had, then your limitation just becomes whatever your actual losses were. That goes all the way back up to this general rule here. when we're always deducting the smaller of what really happened or what our limitation was. All right, so in a nutshell, that's gambling. And that's really the last of our main itemized deduction pieces from Chapter 6. We'll go back the other half of this item where it lists here for the from AGI section where we had it's a greater of itemized or standard deductions. What this means is for the itemized part, we've gone and applied all of the rules that I've talked about over these 4.5 installments. You add them all together and you hope that you've got a number of itemized deductions that's big enough that it's going to help you out on your taxes. By help you out, I mean that it needs to be bigger than the standard deduction number. If it's not bigger than the standard deduction that the government gives you, you wind up just taking this. So in either case, you got to go through the motions to figure out what amount you qualify to itemize, but then you just wind up taking either itemized or standard based on the one that helps you more. You get the best one that works for you. So getting back to the slides where these itemized sections leave off, we just go into the standard deduction and exemptions. Standard deduction is just those amounts that come straight off that PDF that we always use that has just the normal tax rates. So like for a married filing joint couple in 2012, the standard deduction is $11,900. And it just goes down from there for single people and heads of household, things like that. All that standard deduction is just a flat amount that the government sort of adjusts for inflation every year, and they say this is the baseline amount of deductions you're going to get. It's the same amount. It's a benefit that's available to everyone, and you can either take it, or if you're doing all these other stuff that kind of like qualifies for itemized treatment, you can do itemized instead. But at a minimum, you're going to deduct the amount that is captured in that standard deduction. There's a little bit of a caveat here for this standard deduction for an eligible dependent. So by eligible dependent, we're talking about, maybe it's one of you, your parents would like to claim you as a dependent on their tax return. So say they do that. They claim you, they get a deduction for you elsewhere. You can't then turn around and claim the same deductions for yourself on your own return because that would be double dipping. So your standard deduction as this person who's eligible to be a dependent on someone else's return becomes the greater of $950 or earned income plus $300. So an additional limit there is that if this earned income plus $300 amount just winds up being more than any of those sort of generic standard deductions that are in your PDF table, you're going to be limited to that amount. But what's really important to pull from this is that earned income is very specific. Earned income means that you have a job and you're working for it. It does not count like dividends or some interest you might get because you have a savings bond or just a savings bank account, something like that. This is, like in the case of a child, if they babysit, this is babysitting money that they're supposed to be claiming for tax purposes. Or if you're a waiter or a waitress at a restaurant, that is your earned income. It does not count all this extra stuff you might have just because, you bought some stocks or somebody opened a savings account in your name, something like that. So it's just where it can get a little bit different for someone who's eligible as a dependent on someone else's return. The kind of normal standard deductions, the one that we're mostly going to talk about, are just these numbers are the same as what comes out of that PDF table that I'm just going to give you on an exam. So like I was saying before, the married filing joint standard deduction was $11,900, and then it just kind of goes down from there. It gets cut basically in half by the time you get to a single person or a married filing separate. There is, on top of this normal standard deduction, there is an allowance for a little bit extra for people who are of a certain age or blind. So if you meet the requirements here by either being blind or above a certain age, which can be revisited periodically, but it's always listed in the tables that you get. Um, if you're old enough, you meet those requirements, you would get, say, in the case of married filing joint people, you would get 11,900 plus another 1150. Or for head of household, 8,700 plus another 1450. Uh, and we'll point out that these additional standard deductions, they can apply per person. So, like if you have a married couple, for instance, and they're both over 65, they could both get another $1,150. So it would be 11,900 for the couple plus 1150 for one spouse plus 1150 for another spouse. If you had a couple where one person was old, they were 65 or whatever, and then another one who maybe wasn't as old but they were blind, same deal. You could get one for the old person and one for the blind person. The only point that you don't get to double dip if you have a person that's old and blind. They just get one 1150. You don't get to double dip in that sense. All right, so last slide of the chapter. All this comparison that we've done of it's this greater of test where we add up all our itemized stuff, we compare it to what we just get from the government in the form of standard deductions. It creates the need for strategy. So what we talk about in terms of kind of tax planning with regard to deductions is what we call it bunching itemized deductions. All that means is that if you're going to do things that qualify for itemized deductions, like buy a house and pay interest on your mortgage, or you have some medical expenses, or maybe you just have a bunch of that employment related stuff that falls under the 2% category. No matter what it is, the strategy is to do all of that stuff at once and get that total itemized number as big as you can so you can deduct that in one particular year. If you've got the same amount of deductions itemized over time, but you only say have like $1,000 a year and you stretch that out over 10 years or 15 years, you're never going to get a benefit on your return from those things because it's always going to be in your best interest to just ignore your itemized stuff and go with the standard deduction. But if you can time those activities so that all of that stuff hits at once, you can get a really big number for your itemized deductions and apply them all in 1 year. And maybe you get a benefit that's way bigger than just taking the standard deduction that year. So by bunching, all we mean is that there is some strategy in trying to time when you do these things. But to that effect, like we've been saying for basically every chapter that we've got into, you got to be really careful with this stuff, and you can't get too cute with the government. So by timing, I mean, you really do have to either accelerate some activity that qualifies for a deduction or put it off. And, in doing that, sometimes there's risks that come along with that. Maybe you really need some kind of medical treatment. It doesn't make sense to put that off for a year just because of taxes. There are probably people who do it, but they probably shouldn't. So just be aware that bunching, it is a strategy that exists. It is discussed. It is used, but there's always that need to have kind of common sense sort of trump your tax planning considerations. With that, that is the end of our discussion for Chapter 6. There will be a quiz on Monday when we return, but I will not see you guys Wednesday or Friday. So have a great weekend.